The broadcast is now starting. All attendees are in listen-only mode.
Well, good evening, ladies and gentlemen, and good morning to those of you in the Southern Hemisphere. Volume's great. Thank you, Terry. And nice to see you all with us today. My apologies for being a few minutes late this morning, as usual. Just when you don't want it to happen, all sorts of things do happen with dogs and the gardener coming and one thing and another. Anyway, just the trails of a domestic life, but nice to have you with us. Lots of people today, good to see you. Lots of old friends and lots of new people as well. Tony, hi, Otmar. Mr. Deck, we haven't seen you for a long time, mate. There's my mate Alan up in Brisbane. Alan Varian, a good mate of mine. Brian up in Weewaw. Chase, who has had me constantly to stop smoking, and I should. Chris, yeah, David Webb, Webby, the king of the black lines. They've been pretty dramatic lately, mate, haven't they? They're fantastic. Don Medell, he's a tutorial guy up in Canada. Eric Trotter up in Dubai, also a tutorial. Franklin, Betty Franklin's been with us for years and years, one of our oldest members. Lovely to have you with us. Franklin, Hank Bully down in Singleton, middle of New South Wales. Harold over in Reading. Gosh, one of my earliest clients, Hugh, Ian, Peel, yeah, all the people. Johnny Barnes over there, John Listman down in about to become one of my star traders, I think. John L. down in Coffs Harbour. He did a video version of the tutorial with me late last year, and he's turning out to be a bit of a star trader. He's doing very, very well. With what he learnt at the Daniel Code tutorials, quite changing his life, I think. The Marks are with us. Great to have Marilyn. Gosh, we've got a lovely lady with us. We don't have very many of them, Marilyn. Get your friends along. We need more ladies. Mike, my gun trader in Chicago, Mike Mitsos, the super gun. Good to have you with us too. He's another tutorial guy, did so well. Mike Murphy, Mr. Deck, haven't seen you for a long time, my friend. Norbert, oh Lord, Pete Andrews, first guy I ever taught the Daniel Code to, still with us all these years later. I won't go through them all. Rob H is my other mate from New Zealand. Good to have you with us. He's a very, very, very smart guy. Thomas is having trouble with the sound. Just let me send him a note, if you would. Thomas, not Thomas, that's Thomas John. Email. Excuse me, folks, I'm just trying to fix up an issue for one of our clients. Yeah, any of you having problems, John Barr, sounds good, Shetland, Ontario, yep. Sounds good everywhere. One of our clients says a number of you occasionally have problems with the sound. If you do have those sort of problems, email Terry. It means your setup for Citrix is not right. He can fix that, or you can contact the help desk at Citrix, and they'll get you set up. Good on you, Hank. Okay, so wow, lots of great friends with us here now today. Good to have Terry Knight with us. Terry, nice to have you, mate. Tom Janovic over there. Tom, I got a message for you. I got your email, mate. I'm going to deal with it. Good to have you all here. Folks, pretty interesting time. What have I done here? Change the screen. Let me just see if... here we are. Let me catch up with what we're doing. Here's the audience view we want, so you can see what you're on. We're recording. Everything's good. Pretty exciting time, folks. I think, the old saying in the stock market, which we'll never be rude about people who trade stocks. That's actually what we get our indices from. So without the stock market, we wouldn't have all these wonderful futures contracts on the indices to trade, but their old saying is sell in May, go away, sell in May, come back in September. And we've had this extraordinary period of low volatility, particularly in the indices, the equity indices. I think we've had 43 days up until last Friday without a 1% move in either direction. It's just been extraordinarily moribund. I talked to you about that at the last webinar, those of you who follow these webinars with me. And I said, don't get lulled into a sense of complacency, because these sort of periods of very low volatility often resolve themselves in a burst of volatility. These markets are all mean reverting. And in fact, that's exactly what happened. And we've had the most extraordinary few days of trading. We had the big sell-offs in the equities on Friday and Monday, and lots of other things as well. And volatility has had a real jump. So let's have a look at all this good stuff and see how we can profit from it, which is the name of this game. You should see a new page coming up very shortly. Folks, we get an awful lot of you at these webinars, and I love having you with us. But for those of you that are interested in trading, for goodness sakes, please don't be shy. You can start with a free trial to the Daniel Code, a free trial to Trade Navigator. Terry can organize that for you. And on this screen here, you can see what you need to do. You just go to the Daniel Code website, www.thedanielcode.com. You check on the banner that says free trial. You follow the prompts. You register a username. Send that to Terry at support@thedanielcode.com. And Glenna, Sister Sage has arrived. Good to see you, darling. Glad you're with us. Say hello to the Big D for me. Then Terry will organise you to be set up, and we can get you a free trial of everything at the Daniel Code, the fourth seal, everything, the Daniel Code tools. It's called the Daniel Code Library, but they're the Daniel Code, special Daniel Code tools, and we can even organise a free trial of Trade Navigator for you. So please don't be shy. If you're interested in trading, this is the place to get started, to learn more, and eventually, for those of you who want to, come and do some tutorials, and we'll take you to the absolute very highest level of trading that you can possibly imagine. So please take advantage of that. Don't be shy. Terry's there to help you, and so am I. And if you're doing your free trial, you've got questions, send them to Terry, copy them to me. Our emails are on the website, and we'll be more than happy to respond to you. Our next tutorial, folks, and our last one for the year, is going to be again at Waiheke Island, New Zealand. As you can see, it's the most beautiful island in the middle of the Hauraki Gulf of New Zealand. That's the start of summer in the Southern Hemisphere, and this year it'll be the 4th to the 7th of December. That's a Sunday, Monday, Tuesday, Wednesday. And what we do on the Sunday, I think Pete might be organising a nice boat trip for us around the Hauraki Gulf and the Auckland Harbour. Sunday evening, we have the cocktail party for everyone to get to know the other folks who are coming, say hello to them. And then we have teaching on Monday, Tuesday, and half day Wednesday, and we mix in there a cocktail party, a group dinner. I take you out to one of the wonderful restaurants at Waiheke. We usually organise a function up at one of the big vineyards there, some of the world-class vineyards at Waiheke. So put that in your diary, folks. It's just about 3 months away now. I don't want any of you to make other arrangements, so you can get your Thanksgiving out of the way if you're in the States, and then come on down to New Zealand. You fly into Auckland, take a transfer to the Auckland ferries at the Viaduct, and it's about a 25-minute ferry trip over to Waiheke Island. The ferry trip alone I always think it's worth the trip just on its own. It's fantastic. So looking forward to seeing you folks there. And I've told you nice and early now, Sage, so don't tell me that you can't find a babysitter for your cat or that Mustang's off racing cars or motorbikes or anything else. I'd love to see all of you there. Okay, let's move on and have a look what's going on with these markets. And there is a large difference between commentary and reality. And if you read the daily financial papers, which I call the comics or the funnies, you'd be forgiven for believing that doom is here, the end is nigh, everything else. Curses on the banks, curses on the Fed, all central banks, curses on the fiat money system. A lot of our friends haven't got over the fact we're no longer on the gold standard. But this is the most telling chart of all. This is the Daniel Code trend chart. This is the 24-day chart. It's a very long-term chart. Each bar here is 24 days long. And you can see, if you just look in comparison to what we used to think was normal, have a look at the 1998 to 2000 range, and see what the central bank, particularly led by the US Fed, have been doing with interest rates. Now, T-bonds, the chart of T-bonds is inverse to the interest rate. So as this chart climbs up the page, it means interest rates are going down. And you can see this extraordinary chart had got up to approaching 3 standard deviations from the mean. And that sort of a range of movement is almost unheard of in sophisticated markets, particularly very conservative controlled markets like major countries' interest rates. And you can see that it topped out just one period before its last 59 cycle, and it's gradually working its way back into the very long-term trading channel that's been controlling it since February 2000. These time cycles, as you know, are plus or accurate to plus or minus one period. So it's just doing exactly what it's supposed to be doing. But the fact that this chart is going down means interest rates are tending up. And there is the whole world of commentary is based on the premise of ultra-low interest rates, what the US Fed calls accommodative policy, which is code for as much as you like at virtually no interest for the privilege, for the people who are funded by the Fed. Now, it's not you or me, of course, and even though interest rates have come down a long way, they're still, excuse me, for the average business, they're not that accommodative. Let's see, I don't know if, let me reply to my friend who's having the problems. He said XP was his problem, his Windows 7 required. To which I'd say probably. Okay, so let me deal with this. I'm sorry, folks. I don't see what it is. It shouldn't matter. No, Terry says shouldn't matter. I don't think you can hear us, Terry. I think that's the problem. A guy called Thomas John Terry, if you have him in the database, please shoot him an email, see if we can help him. Okay, let's move on. So we've had this endless commentary for years now, and the fact is that this whole structure of finance has changed. I, being an old bloke, always think that things are going to go back as they were, but I don't see that in the foreseeable future. It's undoubtedly true that the amounts of money and the interest rates available have caused massive, massive asset bubbles. There's just no doubt about that. None more so, incidentally, than we're seeing in real estate in Canada, Australia, New Zealand. other developed countries, with Australia and New Zealand being the absolute standouts of the bubble crowd. And this has all been government policy. These things don't happen by accident. Don't believe for a moment there's anything accidental about these extraordinary times that we're living in. But, you just can't see that central banks are going to be able to raise rates dramatically, even if they wanted to. And at the moment they don't, because the primary scenario we have at the moment is deflation. We have surplus capacity everywhere. Surplus capacity has been built on the basis of this extraordinary financial accommodation that the big players have been able to harness. And with surplus capacity, if you can't find a way to fill it, which nobody can, you're going to get a deflation. Now, I personally think deflation is a jolly good thing, but don't tell an economist that, because it gives them a heart attack. We had an extraordinary couple of days over the last weekend with all of our signals, and I wanted to show them to you. For those of you who are traders, the most important thing in trading is firstly knowing what the signals are. We try to help you with that. Thereafter, knowing what the trend is so you can manage your stops. Now, those of you who've done tutorials know that I teach you several very unusual ways to see trend that the rest of the world doesn't see. And when you see trend, you can use a trailing stop. And when you're clear that you're with the trend, you can use a trailing stop or some other stop loss technique. And when you have a signal against the trend, it may or may not be a reversal that sticks. We exit first profitable close and then see what the market wants to do from there. But this was the sell signal in T-bonds. For those of you who've done a tutorial who can read trend off daily charts, you were able to hold on to this and make a lot of money out of it. This is the VIX, folks. Your charts will just be changing now. This is the VIX index. This is an index. It's actually the market volatility index called the VIX, and it's the so-called fear index. And if you have a look at the what's happened recently, you can see the big spike when we had the last little bit of drama back in the early July. Then we've had this period of absolute dormant VIX right through, where we had the 42, 43 days of less than a 1% move either way. And now we've had a big spike up in VIX as volatility's returned. And I suspect that we're going to see good volatility through to the end of the year. September to December is a great time to be trading, because it's volatility that gives us the big bucks. And I was talking to one of my clients the other day about a difficult time in trading, and I said, look, the reality of trading is it's a bit like long distance ocean racing, which I used to do a lot of, Sydney Hobart yacht race and Sydney Hamilton Island and those sorts of things, Noumea race. 90% of it is periods of great boredom, interspersed by 10% of absolute terror and panic. And trading is much the same. But it's actually the times when the rest of the world is having terror and panic that you make the really big bucks, as you can see from some of the charts I'm going to show you. And that's what really tops up your equity curve. And it's vital you get those trades. You've got to get those trades. So if you're not getting them, please have a look, take a free trial of the Daniel code, and you'll see just how we can help you into that. This is the S&P E mini contract I'm showing you, and this trade was elected. We had a TO3 sell signal here. Let me bring up the other chart, please. Yes, it's here. We had this TO3 sell signal last Thursday. That's the grey bar. That was an outside bar. The trade was elected, did not give you a first profitable close, so you had to hold it for the next day, which was the Friday, and aren't you glad you did? Because that was the big one-day sell-off. and that bar alone was worth 2,700 per one contract in the S&P E-mini. You can see where this market went down to. Just observe how incredibly well this market runs to the Daniel Code numbers. And that's one of the major points about the Daniel Code and why it's different to every other trading methodology, that it creates these proprietary price levels from the charts and allows you to measure what's happening in markets. I'm going to show you more of that later, but you can see that we had a blue line there at 2113. The low of this crash low, if you want to call it that, it was certainly a hugely dramatic day last Friday. The low was 2113.25. The Daniel Code blue line was 2113.25. And I mean, it's extraordinary. This is a panic situation. Nearly all other trading systems just get blown to pieces. What happens with the Daniel Code? It goes exactly to the blue line number. And to reinforce that, you can see the low on Tuesday, 2112.25, and the low on Wednesday, 2112. All of which are variances of less than 0.01%, much less, and it shows you that the market's just finding that Daniel Code number, which is what markets do all the time. It's extraordinary. So naturally, we had an update today, and in preparation for the typical Friday update. I don't know if that's going to happen. I haven't put in any signals for the equities because the risk is too large. If you had a look at buying Thursday's high, if you weren't already in the trade, then you can see where your stop loss is below Thursday's low. It's far too big, way outside our risk parameters. And when you get heightened volatility, you need to be thinking about your risk parameters. And if the risk is too big for you, use a trailing stop. You can put on a dollar stop, whatever your risk is that you're comfortable with. You can express that as a dollar number and make that a dollar trailing stop. So as the market continues to go up or down, whichever signal you've chosen, the trailing stop follows it at that dollar value, and it's locking in value as the trade progresses. And then it'll get you out if the trade reverses. So you're going to face a lot of that, I suspect. We expect to have good volatility now through the end of the year, probably the best period of the year for trading. This next chart, which you should be seeing in a moment, is gold. It's just changed. You can see we had a blue line and TO3 buy signal. As a result, if you go to the bar before that, you'll see this same thing of target recognition. I'm talking about the bar of Wednesday, August the 31st, which is this bar here, if you can see my cursor. And if you can't, it's the one before the one that has the arrow on it. It was the bar that set up the blue line buy signal. The low of that bar is 1306.9 against the Daniel Code blue line at 1307. In other words, absolute perfect target recognition, along with the other requirements we need for our blue line trades. They're the ones we urge you to hold with a trailing stop on the fast stochastic. And this trade made straight up, and then we had a plus sell signal. We had a TO3 sell signal in Huey. For those of you new to the Daniel Code, Huey is it's an index. It doesn't have a futures contract associated with it. It's the index of unhedged gold miners. There used to be 25 of them. That number moves around a little bit now and then. But we put up the Huey signals because gold and silver are highly correlated, not only with each other, but also with Huey. So a signal in any of those three, gold, silver, or Huey, can be executed in the other. So a signal in gold can be executed in silver, and vice versa, and the same with Huey. So we had a TO3 sell signal in Huey, which led you into the next day, but in case you were to miss that, we also had a plus sell signal. Those two little trades there The bar's now got a few more bars on it, this chart. I used Wednesday night's chart for this particular display, but that's 4,100 plus dollars just in 2 trades. I just want to show you how marvelous the trading's been. This is silver. Same thing. It had a plus buy signal, and then it had the TO3 sell signal in the correlated Huey, followed for a, in case you missed that, I put up a plus sell signal as well, and that's knocked out $7,600 in 2 trades. And we move on now to the Russell. This is another one of the equity indexes. Very important to remember with the Russell that this is the US Fed's preferred measure. The Fed does an awful lot of work with the Russell and takes it into account in its deliberations, why it's so important. This is actually the small caps index. The Dow is the super big heavies, the S&P 500 is the next 500 biggest companies, and the Russell is the small caps, often overlooked but very, very important from a technical point of view. And right now, excuse me, the Russell is showing a massive divergence against the NASDAQ in particular, signaling something that needs to be resolved. All of these divergences get resolved in due course, but when you get divergence, you want to be aware of it, and it's just an alert to be a bit more on your guard. So that's the Russell. It was another $4,000 plus trade just on the one day. So these are the sort of trades, folks, you can't miss. If you didn't get all of these, you should be thinking about getting yourself involved at the Daniel Code. This is Germany's DAX. I know not many of you trade it. Some of our European clients do. And you can see it's a big index. It's a very big margin. In fact, I don't know how much longer we should continue covering the DAX on the public website. We do it privately for some of our private clients. We have a number of hedge fund and prop traders in Europe who trade this index. It's a big index, but the margin alone is about $20,000. It's a nice trade, and 25% on margin there was certainly nice enough. Okay, moving to currencies. You guys, I know, often feel that I spend too much time talking about futures and not the Forex and the currencies, the Forex pairs. This is, we had the same thing over this whole period surrounding last weekend. This is the Aussie USD, and we had a heap of others. And there was your plus sell signal. And down it went and down it went. Then you got the final panic drive down. And look where it finished up. 7441 was the Daniel Code blue line on your charts. These go on your members' charts, and they're upgraded twice a week. You can see them in the Daniel Code website. And that low on Tuesday was 7442, 1,000th of a point away from the blue line. Perfect target recognitions, which what forced the inside bar the next day. And of course, we had pretty obviously a buy signal going into today. In fact, we had a TO3 buy signal for Wednesday, valid for Wednesday and Thursday. That's not on this chart, but we had a nice little run up today in Aussie USD. So we've sort of spent a whole lot this week counting the money, folks. It's been fantastic. If you haven't got these trades, if you didn't see them, if you didn't, it doesn't matter whether you took them or not. I know a lot of you have limitations on how many markets you can trade, but if you didn't see all of these trades, goodness sakes, let me know, and we'll get you fixed up for a trial so that you don't miss what's going forward. Because I think this sort of volatility comes in waves. It waxes and wanes, as the poetic would say, but it's a good sign to get a nice burst of volatility before the main trading system run into Christmas, when all the Europeans have come back from their 6 to 10 week holiday, and a lot of the wealthy hedge fund managers who can afford to do so have also taken their extended break. It's a very common thing to have what we call, excuse me, summer markets, and it's quite traditional for all financial markets to get slow over the summer periods, as a lot of the main players take leave in that period. This is a chart I want to show you, very important for you to see. I'm always stressing this point that if you can't measure it, you can't fix it. If you can't measure it, you can't profit from it. All the old sayings about corporate management, with everything that's happening in your business, your life, everything else, if you can't measure it, you're not aware of what's happening, and you certainly don't have a way to fix it. Now, this is quite an extraordinary piece of chart. This is the copper chart. This is the copper futures chart, and we had here this one. Let's go back. I'm going right back to this bar here. If you can see my cursor, it's the one just beside the 208.10 number, which was that Daniel code blue line, and it reached there on August the 25th. And we then just had 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13 bars, all trading within the previous bar's range. And we saw these breaches of the Daniel code blue line, which set up a Daniel code blue line trade from the bar on 8.25, had its low at 208.15 against the blue line 208.10, and it was struggling for target recognition. Markets have to find these Daniel code numbers before they can turn, and it's extraordinary. And I probably can't convince you of that by telling you, but the people who've been with us a long time, who see these charts every week, they prove it to themselves. Markets will not turn unless they're at a Daniel code number. And on the Daniel code website, we actually have a link which is called Chart Archives. And I think that we have now well over 30,000 individual charts, which I create by hand twice a week. And you'll see there we have a heading or a tab called Chart Archives. Terry, I don't know whether everyone can see that link or they have to be a member or a guest to see it. But anyway, certainly if you're doing a free trial, you can see it. Members can see it. And there's a tab called Chart Archives that shows you every chart I've created since 2008. And you'll see this happening again and again and again. But this is so dramatic that what I'm showing you here, for 13 days you had this market struggling to rally, but it couldn't, because it had found its Daniel code number at 208.10. It had then had 1, 2, 3, 4, 5, 6, 7, 8, 9 days breaching those levels. And it was struggling, frankly, to find the next Daniel code number. Okay, members can see those charts under the Chart Archive. Terry tells me members can see all of them. The others, everyone else can see them, but they're 1 month delayed if you're not a member. Excuse me. This market struggling for traction, struggling to do its overdue rally. And look what it did. It had this enormous outside bar, which stopped out all the longs, got everyone wrong. And once it had done that, it was happy to make this nice rally. And the low of that outside bar from Monday, September the 12th, the low was 206.40. Have a look at the blue line, which was on all the members' charts, 206.40. And that was a really fast, frantic snapback reversal. But the point that our members know is that when markets get frantic, the Daniel code numbers actually become more accurate. The market went there because it knew it had to find a Daniel code number before it could make its reversal and take off. And I'm not suggesting for a moment I saw that coming. I knew intrinsically that it would have to find a number. but I certainly didn't alert you to the fact that it was going to go down to that number on that day. But I'm showing you this just to show you what the Daniel Code does, and it does this again and again and again, and it's absolutely extraordinary. Okay, let's move on. Trouble in Paradise. As you'll see the new line coming up. Australia and Canada are very interesting countries from market point of view, because they're both countries, Australia in particular, require huge amounts of international capital to build out their infrastructure, and they're net borrowers in the financial markets. They're both, really, the currencies are both what we would call mineral-based or energy-based markets, and they've got a fair bit of volatility in them. They're both also having massive housing booms, none more so than Australia and New Zealand. Now, some of this, it's a long, detailed story, is caused by Chinese buying. China, there's just massive amounts of wealth in China. There's a great fear by sophisticated investors that there's going to be some fairly dramatic devaluations in the Chinese currency, despite the best efforts of the Chinese central bank to keep that currency in a range. And the preferred method for those who are fortunate enough to be able to get their money out of China is to buy real estate in countries that have strong real estate markets and booming real estate markets. For example, Australia, in two states in particular, capital of New South Wales, Sydney, and Melbourne, the capital of the other big state, Victoria, as much as 50% of unit buying is being done by overseas Chinese. And the prices that were already madly a boom have just gone through the roof. I don't know quite how to say it, other than to tell you that you simply wouldn't believe the prices of real estate in Sydney and Melbourne. I've lived in Australia for the vast majority of my life, certainly owned property here for the last 50 years, and I don't believe it. It is extraordinary, the size of the bubble. And the froth, the bubble was always there, because of the government policy and Australian Reserve Bank policy. But the froth came on with the Chinese, and you can see all sorts of commentary for those of you who are interested. The state of Victoria has just put on some limits on their unit, or what you'd call apartment. In America, we call them home units here, apartment living really. They put limits on, insisting that the small little boxes that the developers have been plunging into the market, they have to stop, and they have to build, have a better setback and a lower site ratio coverage. In other words, fewer units on each site. And there's been turmoil about it, because the point that's been missed is that those of you who are familiar with Hong Kong and other big cities now in China, it's a different lifestyle. It's a different outlook. And Asians in particular, who've been brought up and forced to live in very crowded cities, they're happy with much smaller apartments than Australians, Canadians, or Americans would consider as reasonable. And this is causing a whole lot of controversy. But you should read this stuff fairly interestingly. We know what's happening in Vancouver. Luxury homes plunged 65%. And that's very much identifiable as being the buying by mainland Chinese. We then move on to Australia. The household debt here dwarfs that of the US at the peak of its housing bubble, and we know what happened there. The Australian household sector is the most leveraged in the world. Debts equal 125% of GDP as of the first 3 months of 2016. And that's way above, more than 25% above the peak of US subprime lending in the first quarter of 2008. And you can get a pretty good idea what's going to happen here. And then that's from comments from The Economist at The Guardian, as is the next comment. Back in Australia, economy's not looking healthy. This is a point I made, excuse me, folks, at the last webinar, or the one before perhaps, that we are fixated with GDP, gross domestic product. Now, don't all roll your eyes and throw your hands up in horror when I start talking about this stuff, because it's really very simple. GDP, or gross domestic product, is the preferred number that governments want to use. It's the one you get shoved down your throat every week on the financial shows, and it's the one to which cost of living indexes and all that sort of thing relate to. And it's the government's preferred measure of growth because, frankly, it's always going up in these sorts of progressive countries. But it's actually not the one that affects you. What affects you is your disposable income per capita. And there is a measure for that, and it's called NDI, or National Disposable Income Per Capita. And that's how much income each of us are getting. And that, in Australia, held up as a booming economy and one of the growth engines of the world, that has been falling for 17 consecutive quarters, which is over 4 years, folks. So we're all getting a bit poorer. We're not getting as much income individually as we used to. And the reality is that to individuals, small business people like us, GDP means nothing. Disposable income means everything. And that's been going down for 17 quarters. So where is this wealth effect, these massive, ridiculously priced properties? Where's all that coming from? And the answer is debt. And I stuck in a little at the very last paragraph of a little sentence on the page saying, if house prices fall, homeowners are stuck with a mortgage 5 to 10 times their annual income are going to be in trouble. And I put that in because I've been saying for some years that this idea that borrowers are not getting funded for any more than their debt level is no more than 1/4 of their income is absolute rubbish. I've even been so amused by it. I've talked to a number of bankers, mortgage brokers, saying, how on earth are people affording these mortgages? And, you know, they're saying, oh, we're only lending 90%. Rubbish. They're lending 93, 97, 100, in many cases 103%, because they lever up a couple of other products. In other words, new buyers of real estate are up to their ears in debt. And if interest rates rise, they're going to have trouble paying it. But more importantly than that, this debt has been taken on in the expectation of continuing capital gain. And that's already starting to roll over, particularly in the home unit or apartment markets now. And where they're having settlements of properties, they're starting to see a level of default. That is, people are not able to settle now because the banks, APRA, the Australian Prudential Regulatory Authority, has asked the banks, forced the banks. Banks never do anything, if you ask. You need someone to put the thumb screws on them to do anything at all, including being slightly intelligent. And they have limited lending, mortgage lending to non-Australian citizens, overseas residents who can't prove their income. But this whole property boom goes on the greater fool theory. Your property will be worth more, you'll be able to mortgage it for more, you'll be able to sell it for more. And this can't go on forever. Those of you who've been with me a long time know that I'm essentially an optimist. I'm not one who has ever made comments of this nature, except for the last couple of webinars. I've been warning you that I think the beating drum, particularly in Australia and Canada, is starting to sound a bit sick, and that gives us some hope of more drama, which equals more volatility. So, looking forward to that, and bring it on. This chart I've just switched to now. This is the Australian US dollar forex pair. And the heading I put on that is that this chart is the very definition of government policy. Now, Doesn't matter whether you're interested in the Australian dollar or not, because the same thing happens to all of our currencies. These market moves are not random. They are a result of deliberate government policy. You can see on this chart in the period back in 2010, 11, 12, you can see that the Australian dollar was over $1 US. In fact, it was up to $1.08 US, which is frankly ridiculous. Why? Because Australian government interest rates were so high. And the subplot of that was that massive amounts of funding needed to be borrowed to fund. That was the build-out and expansion phase of the iron ore mining in Australia, which is huge. BHP, Billiton and Rio Tinto, the biggest miners in the world from Australia. The build-out and, Hammersley, Gina Rinehart's projects, Chevron's gas discovery, Barrow Field build-out in West Australia, billions and billions and billions of US dollars required to fund that build-out, to buy US equipment, and the side effect of this policy really was done for the miners. They got this massively inflated Australian dollar at $1 to $1.08 US, which helps them so much with funding that US costed infrastructure. Now you can see what's happened, that as interest rates have reduced a bit, the market's gone down. You can see it's bounced off all of the Daniel Code numbers on the way, either the blue lines or the red lines, which are the internal retracements of the operating range, and it made its low. It just broke through the 68, 67. And it's now rallied back up to one of the red line retracement, 78.18, trading now a bit below 75 cents. Why is this demand? Why has this market rallied from February this year? Well, Australian bonds, AAA rated, are 2.75%. Doesn't sound much to you or me, but when the alternative is negative to a quarter or maybe a half, it's terribly, terribly attractive to overseas investors. And they're buying the Australian currency to get access to these government-guaranteed bond rates. So, once again, we have a artificially supported dollar. This dollar needs to be down around, you can see I put a red box around those next two levels of Daniel Code support, around 65.5 cents. That's where this currency should be. It's being held up, even though the government has, the federal, the Australian Reserve Bank, the central bank in Australia, has reduced interest rates. They're still 2-3 percentage points higher than the competition in the world. And that's what's holding this currency up. And it's absolutely diabolical for Australian businesses. But that's the point I'm trying to make, is none of these things happen by accident. They're all a result of government policy. And Australian policy at the moment is to keep sucking money into the country, to keep fueling its mortgage boom. And I think we're going to see some problems, and I'm looking forward to that. Chaos is what traders live for. Now, just digressing, Rob's got a big note for me here. New retirement fund as property as capital searches for yield. Property collapses, the retirement funding will suffer, putting social pressures on the economy. If equities fall also, then superannuation will also suffer. All that capital trapped up in illiquid markets. Absolutely spot on, Rob. Liquidity will become increasingly important, and a linchpin, absolutely. Rob's a very smart trader. He's a Kiwi guy that I know. We had a beer occasionally. Haven't seen him for many years, but he's a very, very switched on guy. So that's going to be important. This chart you're now seeing, this is the weekly gold chart. And Tom T, I had an email from you saying, strange stuff, Tom. Let me see if I've still got it, because you said, looking at the charts you display, it appears you believe bond has hit a near-term low. Do you think we could see $1,100 gold within the next 6 months? Well, I don't think our charts are showing that, Tom. I mean, this is our primary gold chart. All I can see it doing is bouncing off the Daniel Code numbers. You can see it turned down here at our fourth seal. We forecast this. In fact, Frank forecasted 6 weeks before with his fourth seal analysis of Huey. Here's the run up. Hits the Daniel Code blue line, corrects, goes to the next blue line, corrects, goes up to the blue line at 1378, and it's now trading in a range between the two Daniel Code blue lines at 1378 and 1308. I don't see any reason to be particularly bearish on gold, other than to say that there is at the moment a fairly strong relationship between gold and the US dollar, which is common. We see that a lot. And if we were to get some big movements in the US dollar index, that would be the time to reassess this, Tom. But at the moment, it looks quite stable and it's got quite strong support there. Here's our compliance page, folks, that I like to show you. Trading in futures and derivatives is risky, and if you don't know how to trade, it's even more risky. So be careful with your trading. Take time to learn. It's not something you can learn free from the internet, but you're more than welcome to come along to a Daniel Code tutorial. You can learn a whole lot of it just from the website and from following the daily signals and the commentary I give you on webinars and in previous articles, which I haven't written for some years, so I better get on to writing again. But you come to a tutorial, I can make you a great trader. If you're good already, we can make you better. If not, we'll teach you how to do it. I had a number of 6-day charts I wanted to show you because we need to be alert to what's going on here. Let's start with the S&P. This is the S&P. This is the index, which is the preferred chart, and you can see all the way from 2009, this whole market has been controlled by this Daniel Code trading channel. Excuse me. We've had the one sell signal where we had a close in February the 10th below the 2 standard deviations from the mean. The thicker line, the thicker blue line through the middle of these 5 lines is the mean, and then the lines progressively are 1 and 2 standard deviations from the mean. And we had the one signal of failure on February the 10th. I told you at that stage that what we could probably expect is a long consolidation, which we've had. And this market has been attempting to regain the mean. Remember that what we're looking at here, we're looking on the angle. It's not just a question of raw numbers. We're looking at the angle that combines time and price. And relative to where it's been previously, this market is attempting to regain the median, which is up here. It's up at about 2267. In fact, Frank has a very detailed commentary on the S&P under the fourth seal commentary that he helps me with, and you should read that. It's very important. And that's what this market's trying to do. It's trying to regain the median, and it's not being successful in doing that. Let's move on to have a look what's happening in the Australian market, which we don't pay a great deal of attention to, but I know some of you do trade it. And this is in a similar sort of position. It's a very different looking Daniel Code trading channel, but it's telling us essentially the same stuff. In here, this is February. We had a break and a close below 2 standard deviations from the mean. They're the failure points. They've already happened. From there, we either get a recovery to the mean or we get a consolidation. What's happening here is this market is consolidating. It's fighting desperately to hold on to the 2 standard deviations from the mean line, and it's not showing enough strength to move above one standard deviation from the mean. The next market I want to show you is oil. That these are all on the 6-day chart. You can see, if anyone's confused about oil, don't be. It's doing exactly what it should be doing. It's just bouncing off the Daniel Code numbers. The black line, which Webby's the king of, you put that on your 6-day chart. Back to the previous low, you'll see it was at 25.68. This low that came in February, the low was 26.05. In other words, 35 odd ticks from that black line. That's the last level of support or resistance of the operating swing. And this swing that you can see on this chart is not the operating swing. It's the previous swing you need to go to now. From there, it bounced up straight up to its Daniel Code retracement at 51.65, and it's now just swimming around below that number. So it's being controlled perfectly by the Daniel Code numbers, doing exactly what we would have expected. Let's have a look at DX, because I think this is going to be the big player. This has got a bit sloppy lately, but here's our long-term chart, which I've been showing you now for months and months. This market's been in a range between 100.83 and 93.39. We had a little bit of a break below that. We had a close in May this year at 92.93, which I would regard as ominous. I would have expected to see weakness in the US dollar, and that hasn't happened so far. In fact, nothing's happened. This market's been moribund since it made its high back in December. All the way back here, it's been on the bigger scale, the 6-day chart. It's been range trading since March 2015. And this is going to be the one to look at, folks. What happens in America really does matter to the rest of the world. It's still the world's reserve currency. It's still the strongest economy in the world. And what happens with the US dollar index is going to affect all of us in a quite dramatic way. So really think you should keep your eye on that. The last chart I wanted to show you was the Russell. We looked at a daily chart earlier on. Here's the 6-day chart of the Russell. This is showing much the same thing as we showed you with the S&P index, and this is back here. This is the March 2009 low. It too has been happily running along its Daniel Code trading channel until back here. We had, this would be the February the 11th, we had one close outside 3 standard deviations from the mean. This is a very, very big pullback in trading terms. And I told you at the time the probability which we got a long consolidation from that. This market has managed to recover to 1 standard deviation from the mean. That's where it is up here. This is 1 standard deviation from the mean, around 1240. It's managed to recover to that, and its next step should be to get to the mean, or the median if you like, and that is up here at about, move on a little bit here, it's up at about 1350. The problem is that this is a prime place for this index to fail. I can show you this pattern in many, many markets where you get a break, you get a rally back to 1 or 2 standard deviations from the mean that then becomes resistance, and this is a prime place for this market to fail. So really, we're having most exciting times. Malcolm Turnbull, our new Prime Minister in Australia, who just held on to government by the skin of his teeth, said it's the most exciting time to be alive in Australia, a time of energy and innovation. Well, I don't know about any of that. I think that's just the usual Politico spin. But I can tell you what, I do think it's an exciting time to be trading because I think that we're going to see more volatility. And if we do get to see some more sustained sell-offs in these equity markets, the market is so geared, everyone's in a one-way trade, we're going to see some carnage. And carnage to us means opportunity and dollars. Yes, David, thank you. Jobs and growth. Didn't say what sort, and certainly not talking about our net income availability in this country. Yes, the joys of politics, they're useless sons of bitches. But be that as it may, hope is coming, I'm sure. I'm not sure what it is, but it may. But we see some sell-offs in these equity markets, folks. You're going to see volatility, drama, and hopefully carnage like we haven't witnessed for many years. So being traders, we don't care if the market goes up or down. What we do care about greatly is volatility, and I think we're about to experience that. So get your bunny ears up. Follow the Daniel Code signals. Don't try and form a view. I don't want you to become bearish all of a sudden or bullish. In fact, we don't care which way the market goes. We just take the signals as they come. But what we do know is that once we get more volatility, exciting times come to us. Okay, so that's about all I had for you today, folks. Thank you for being with me. It's lovely to have had you here with us. And we'll be back in a fortnight. Please do write to me. Email me, jneedham@thedanielcode.com. Let's see if I've got an easy chart that got that on. Usually the big S&P chart has that. Here we are, jneedham@thedanielcode.com. Oh, this is something beautiful. This is it. Write to me here, folks. jneedham@thedanielcode.com. Do your free trial. If you're not doing a free trial, I ask you to do that for your own benefit. And write to Terry or me if you have any questions. For those of you who are trading, if your trading needs a refresher, come and I'll see you in Waiheke Island in December. Or you can email me and I'll be happy to talk to you about it. Look at this. This is an interesting chart. This is our, I don't know if we've seen it just lately. Let me expand this so you can see the numbers. This is the S&P index on our 24-day chart, what we call our trend chart. And we had two numbers here. We had 2130.46, and that was 1.5% or 1.5 times the previous range. This is the previous range here. This is pretty cute stuff. Have a look at this. This is, you take the range from the low of March 31st, 2009, up to the high of May the 4th, 2011. If you take that range and extend it from the pullback low that went the 2 standard deviations from the mean, which was October 2011, you got these two blue lines way up here, which I've been watching for a long time. The first one was 2130.46, which we got to in June the 11th. That was 1.5 times or 1.5% of that previous range. And the next Daniel Code number up is 1.593, which those of you who've done Daniel Code tutorials know. And that number is 219151. And this number's been on this chart for months and months and months. 219151. 219591. Look where we got to in September. 219381 on a 24-day chart. The accuracy of this is extraordinary. It's stunning. And that just shows you another way of calculating the Daniel Code numbers. So please, folks, I invite you to join the Daniel Code, do a free trial, talk to Terry, talk to me. We're here and happy to help you. Okay, so thanks for that, folks. Pete, my friend, great webinar. Thanks for the shout out. Enjoy hearing your thoughts. All the best, my mate in New Zealand. Hugh enjoyed it. MSN use. Whoever you are enjoyed it, and I thank you for saying so. That's it, folks. Don, good to hear from you. I hope you're trading well up there in Canada, mate. You know, you're having done a tutorial, you're always welcome to have a one-on-one with me about any questions you might have. And that applies to any of you that have had a tutorial. If you need a refresher, you can do a one-on-one with me. We'll make sure you're up to date. So that's it for today, folks. Peter Clark, damn, I was now late. It's all right, Peter, don't panic. It's recorded, and Terry will have it up on the website by tomorrow, no doubt, and you can see what you missed there. Thanks for being with us. I'll see you at the next webinar in a fortnight's time. If you don't know what a fortnight is, it's 14 days, 2 weeks, old English expression. Some Americans haven't heard it. and I'll look forward to seeing you there. Peter, glad you enjoyed this, and do email me with any questions or any areas of comment you'd like me to cover at the webinars. I'm open to talk to you about anything really, trading, horse racing, drinking, great adventures, yacht racing, that's of the sailing variety, anything that interests you. I've probably done it, and hope you have too. Mac, nice to hear from you. I hope you're feeling well, mate, up there. All right, Norma, thank you, guys. Thanks for being with us, and I'll look forward to your comments and look forward to seeing you and having another webinar in 2 weeks' time. If there's anything truly exciting happening, we'll slap on a webinar at short notice so you'll be aware of things that we're doing. All the best, and thank you for your attendance. Bye-bye.